Planning a distribution strategy can feel a lot like driving in rush hour traffic in a big city. It can feel chaotic, people are blaring their horns, there's noise, there's motion going all over. It can be really overwhelming. And one of the critical things about our mission is we want to bring confidence and rest to clients' financial lives so that they can focus on the people, causes, and activities that give them energy and life, which is often not planning a distribution strategy.
When we lived in Southwest China, we would often joke with our friends that the most entertaining and maybe terrifying video game that you could come up with would be Cab Driver in Chongqing. Because we lived in this city that was 30 million people, and driving in that city was just pure chaos. You would have 4 and 5 lane roads that would intersect at odd angles. You'd have huge trucks coming in with motorcycles, coming in with cars, coming in with pedestrians, bikers. It was all kinds of crazy. And somehow it all seemed to work, but it would raise your blood pressure if you were going through this for sure. And that's, I think, when people approach distribution strategy, they can get very overwhelmed because there's so many different things to consider. You could say, well, we're going to take this general approach unless you have a certain amount of Social Security, because that income is taxed differently. Or we're going to do that unless you're doing a particular level of charitable distributions, or if you have a certain amount of earned income that maybe you could shield with a certain type of investment vehicle. There's all kinds of different moving parts here. And so we've got to bring those pieces together, understand the basic rules, but then also think through what are the specifics of a particular situation that might alter the path that we take there.
Yeah, for sure. Before we get too far down the rabbit hole of distribution strategies, it's really important that we go back and remember that all of our investments, all of our accounts need to have a goal. So if that is new to you, go back and watch the video, know where you're going, the importance of knowing where you're going, or the investment vehicles need to match the goals that you set. So let's talk distribution strategies and things that are important to consider about making withdrawals from investment accounts. So it's really important to begin with an understanding of the different tax implications for these different vehicles, because that's really going to be our headwind when we think about these withdrawals that we want to make. So we're going to go through our 3 primary types of accounts. There's more accounts than this, account types than this, but these are going to be the 3 primary ones that we look at. They're qualified, so think about traditional IRA, your 401k, 403b. We're going to look at Roth IRAs, and then non-qualified. So when we think about qualified distributions, these distributions are going to be, whenever you're taking them out, you're going to be taxed at your ordinary income tax rate. And this is going to increase your adjusted gross income. Now, there is an exception once you reach the magical age of 70 and a half, and you can make qualified charitable distributions. You don't then have to recognize that income. However, by and large, most of the time, if you take a distribution from your IRA, from a 401k, 403b, you are subject to ordinary income. Now, if you take a distribution prior to 59 and a half, then you will most likely be charged an additional penalty for early distribution. Now, there are some ways that you can get around that if you die, but that's more for your heirs to deal with. If there's a disability, sometimes for a first-time home purchase, then you can not have to pay that early distribution penalty. But by and large, if you take anything out before 59 and a half, there will be that early distribution penalty. So just keep that in mind.
Right, and of course the other exception would be 55 and separation of service with 401k, and then also 72T distribution. So, there are ways that we can kind of massage our way around the system, but we have to be really careful because generally speaking, we're going to face those penalties if we don't jump through some additional hoops. The second type of investment vehicle that you highlighted there, the Roth IRA. And generally speaking, if we contribute to a Roth and we're at least 59 and a half and we've had the account open at least 5 years, if we take distributions there, then we're not going to be taxed on those. So that can be a great vehicle if we can get as much growth in there because we're not taxed on that growth. The other thing to remember with a Roth IRA in particular is that we can always access the principal without penalty. So if we make contributions to that Roth IRA and then we find, whoops, I need to be able to take a distribution to help with a child's education, for instance, or a down payment on a home or whatever it might be, then we can pull the principal out there, what we invested originally, without penalty. But if we want to get into the gains, we've got that same 10% penalty and then tax as ordinary income on the gains if we're not at least 59.5, as we talked about. What's that third account? It's the non-qualified account. And again, we come back here, and this is one of those accounts that there's a lot of different things to consider, a lot of things to understand. You're taxed every year on a non-qualified investment, and taxed on interest income, taxed on dividends, taxed on capital gains. So lots of different pieces to that tax equation, and there are some ways that we can work to avoid those or to limit those pieces of taxation. There's also some key pieces that we'll talk about later on in life, towards the end of life, that we want to be able to work around if clients are in certain situations.
All right, so we'll look at a traditional distribution strategy. And by and large, most clients can benefit from this. And that's where you take first resources from non-qualified, then from qualified, and then finally from your Roth accounts. And so why do we do it this way? Well, let's think about running a 5K. If you were to run a 5K in one direction, then either the wind is going to be at your back or it's going to be at your front. But it's not going to be at both your back and your front, because that's not how the wind blows. And so we want to think about how can we use our tailwind and really maximize this. We don't want to run a 5K into the wind. We want to run a 5K with the wind. And similarly, if you were ever to look at the 100 or 200 meter dash, then you can't count the records if you got a tailwind, just because sometimes that can push those athletes faster. And so when we think about this strategy, the non-qualified, qualified, and Roth, we want to really consider what are those headwinds that we're facing. And you mentioned it before, with a non-qualified account, we're facing a headwind every single year from interest and dividends and from needing to take taxes on the capital gains. And so there's a natural headwind to that. Whereas like with a traditional IRA, the headwind only comes when we take the distribution. The tax hit only comes when we take that distribution. So let's start with a simple example. John and Jane have $500,000 in a Roth, $500,000 in a non-qualified account, and $500,000 in a traditional IRA. They're retiring at 60, they have a $100,000 pension, and they plan to defer Social Security claiming until later. They need to take about $60,000 a year from investment accounts from the next few years. So the base case is going to be to use those non-qualified assets first, again, because there is that headwind. They're least tax efficient. So Spencer, you want to dive into the strategy for us?
Yeah, so the strategy is going to be just what you articulated. We want to take from those assets that are going to have the biggest headwind over time, and we want to leave those assets that are actually going to have a tailwind, like the Roth IRA. So if we think about taking resources from that non-qualified account, we're reducing the taxes that we're going to be paid each year on the overall amount of investment that we have. Now, there are exceptions to this. You know, if we have elderly clients that have a lot of gain in their non-qualified account, they'll get a step up in cost basis for their heirs when they pass away. So we want to be careful with that. There's also ways that we could invest resources in a municipal bond type of portfolio for clients in a non-qualified account. The challenge there is that this often doesn't make sense unless we see those clients at something like a 32% tax rate. So we oftentimes would just keep the investments in taxable bonds rather than municipal bonds. Every case is a little bit different there. But overall, we want to recognize that we can take those resources in this circumstance that we've concocted, to our own liking, but a typical circumstance from John and Jane there, because we're reducing that long-term tax liability.
Yeah, and then the second place we want to think about taking from is that traditional IRA. So we want to think pre-tax assets, 401k, IRA, things along those lines. And when you take those distributions, like we mentioned before, those things are generally included in your adjusted gross income. Again, we've said the exception, but we'll say it again, qualified charitable distributions. We love qualified charitable distributions because you're able to push those funds out to charities without ever recognizing them as income. If you want a video on QCDs, we do have one of those if you want to take a look. And you might say, how is this better than a non-qualified account? Well, the reality is you're not taxed every single year on the gains that are in that account. You're only taxed at the time of the withdrawal. So really drawing down those non-qualified assets so that there isn't that continual tax headwind. So then that second place, again, we think, okay, once it's time for required minimum distributions, you can't avoid it. So that's when you got to start. But we don't want to take the tax as ordinary income if we don't have to. So lastly, we want to think about the Roth IRA. And within that Roth, you've mentioned it, but we want to be long-term focused with that. We want to put our most significant growth assets in there so that they can experience that long-term growth. And because the principal and the earnings can be withdrawn tax-free. Again, you got to clear that 59.5 barrier, and you got to have that account open for at least 5 years. But there are situations where we may suggest to clients that it actually makes sense to take a Roth distribution earlier than some of the others.
And this is kind of like a get out of jail free card, because it allows clients to pick when they take that distribution. So if we find that because they have some income that's unexpected, or they need to take an extra distribution, let's just say they get to a point and they're at a marginal tax bracket and they're at the top of that, and they don't want to go into the next one, but they want to take a big distribution for a trip that they've always wanted to take for $30,000 or $40,000, let's say, because they're taking the whole family. Then in that circumstance, it's great to be able to take a Roth distribution so that they're not taxed through the nose on that last piece of income. There's other ways, that we can use a Roth to advantages as well, but it gives a lot of flexibility if we get some resources in Roth rather than just having everything in that traditional IRA or that non-qualified type of account. So again, that's our generic scenario. But just like when you're driving through Chongqing traffic, there's things that pop up. There's a certain amount of chaos that all of us face as we navigate things. So oftentimes we'd have to hop in to the bike lane, or you'd have to go around and go on foot for a season just because the traffic would be so nasty in certain parts there. And similarly, we have to adjust as we look at things that arise in terms of distribution strategies.
Yeah, so let's think about a couple of those strategies. You've mentioned a few of them. Let's cover those briefly and then maybe look at a couple of other situations where we may want to diverge from that traditional plan.
Yeah, so one of them certainly would be if we have significant gains and we're working with folks that are elderly that think that they may only have a few more years to live, we want to consider allowing that step up in cost basis to happen and not sell assets that would trigger that long-term capital gain. Second one, of course, is the qualified charitable distribution, which you've unpacked. And then a third one that I would surface would be Social Security. So Social Security income is taxed in a really convoluted and wonky way. That's the technical term, wonky, I think there.
Middle school dance.
Yeah, exactly. It's really awkward, just like that 8th grade, dance. But you look at the way Social Security is taxed, and it's taxed based on provisional income. So there's this whole calculation, but basically, oftentimes, if we have additional income, it's not just taxed at its own marginal rate, but it'll also kind of sneakily bring in some Social Security income that otherwise wouldn't be taxed, to be taxed as well. So we want to make sure that if we're adding levels of income, that we also understand how Social Security is being taxed on that too. So sometimes it doesn't make sense to recognize those gains, or sometimes we might need to look at a Roth distribution so that we can avoid some Social Security taxation at particular levels.
Well, and like that, Medicare surcharges. If you enter $1 into the next Medicare surcharge bracket, it can be really detrimental. And so if clients are kind of approaching that threshold and they need a distribution, well, if they've got a Roth IRA, let's take that distribution rather than recognizing some income from either a qualified account or a non-qualified account. Another one, continuing on the health front, is health insurance gaps. So we think about clients that have retired, but they haven't quite reached that age where they can start taking Medicare. When they're in that gap period, we want to make sure if they have a low enough income that they can maintain getting subsidies for their health insurance. And so we might take a Roth distribution there to make sure that that income stays low so that they can continue to get those health insurance coverage subsidies.
Another one that sometimes clients won't consider that we see fairly frequently is if we have an IRA that is being designated as a beneficiary to charity, then we want to be careful about how we take distributions there as well, because it may make more sense actually to take Roth IRA distributions before the traditional IRA distributions in that circumstance. So again, we're going away from our example here, but let's just say we had a need for $50,000 as a distribution for folks that are in their mid-60s, but we know that they are planning on pushing their entire IRA to a charitable institution when they pass away. We might say, well, let's exhaust the Roth first in this circumstance, because if you don't take those distributions from the traditional IRA and they end up with the charity, they're not going to pay any tax on it. So more ends up going to charity. We end up taking the distributions from the Roth first sometimes in those scenarios. Another piece that is kind of unique to the next couple of years is that we probably will have taxes step up in 2026. So if you don't recall, the Tax Cuts and Jobs Act of 2017, tax brackets for most folks were lowered then, and they're going to step back up in 2026. So we think about tax planning from 2023 to 2025, and we say, well, this might be a good time to be able to recognize some of those levels of income that if we recognize them later in 2026 or beyond, the tax brackets could be higher then. So that might push us to take a distribution from a traditional IRA earlier and save some of those non-qualified assets, or at a minimum to do a Roth conversion in the midst of that. So that's just for the next couple of years as we think about this. Finally, the last one that I'd surface, and this is not an exhaustive list by any stretch of the imagination, but we want to give you a sampling of the different things that might cause us to diverge from a typical case. But another one would be if we have a client that has a lot of income in a particular year. If we have very, very significant income, whether that be maybe it's the last year of work for a client and they're paid non-qualified stock options, or they get a big bonus, or they have a lot of vacation time banked, or maybe they just have income that's recognized from some other venture in a particular year. We want to be careful about the distributions that we take in that year, because we don't want to add tax upon tax there. We don't want to see that marginal bracket increase and then take some additional resources that we could have deferred for later. So that would be another reason that we would maybe diverge from what we've laid out here and take Roth distributions earlier in that particular year.
Yeah, and just like you were saying, this doesn't cover the entirety of scenarios. There's
not at all.
So many scenarios where we want to diverge from this. And that's why we really think it's really important for you to reach out to a financial advisor. Clients, if you're working with us, please talk to us about this. We really enjoy and we want to help you navigate the traffic. Because if there's 12 lanes of traffic all coming together, we want our clients to feel a level of confidence and rest. So again, don't take this as prescriptive. Remember, there's lots of different options here. Talk with your financial advisor. Clients, talk with us, and we'll see you next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.